Do you know when to pay your credit card bill? Do you know how much you need to pay each month? Do you know what happens if you don't pay the full balance by the payment due date? Are you sure there are no errors or fraudulent charges in your credit card statement? I know, right? It can be very confusing. I remember I was also very confused when I first saw my credit card bill statement because it had several dates and amounts and it was not obvious which one actually was important to pay attention to. I knew that I had to pay it off as fast as possible, but I did not clearly understand what amount to pay, exactly when to pay, and what the late payment fee or penalty would look like. And not to mention, I was so overwhelmed by all the terms on my credit card statement that it was very confusing. So in this video, I'm going to explain credit card bill statement from 5 biggest credit card issuers or banks in the US, different important terms that you see in the credit card bill statement, when to pay credit card bill and what amount to pay, and some common myths about using credit cards that so many people have. So let's go. So first, I'm going to show you what the credit card statement looked like from the 5 biggest credit card issuers in the US and then take one of them as an example to explain in detail. So if you see here, all of them look pretty much the same, which show clearly the billing period, new balance or balance to pay, payment due date, etc. except American Express, which does not show clearly the statement opening date, but you can understand the date looking at the date under US dollar, which indicates the opening or start date. Now let's try to understand the credit card billing cycle, which is very important. So a credit card billing cycle, which is sometimes referred to as a billing period or a statement period, is a time period between statements when transactions post to your account. So there's an opening or a start date and closing date in each billing cycle. So it typically ranges between 28 and 31 days depending on your credit card issuer. The statement opening date is date when a fresh billing cycle starts, and the statement closing date is date when that billing cycle ends. You can find these dates in your credit card statement, which gets generated every month. You can also log into your account and look for this statement or document in the dashboard. You can also download one of the credit card statements from your dashboard in PDF format, which would be easier for you to understand. Now let's take Capital One Savor credit card statement as an example. Here we can see that it says my statement opening date is January 14th and my statement closing date is February 10th, and the time it takes between the statement opening date and the statement closing date is 28 days, which is also known as the billing cycle. So in this billing cycle, your issuer will basically track all the transactions you make on your credit card. So they will keep a history of all the things like items you purchase, items you return, and all the payments you make to pay down your credit card balance, including any other credits you may receive. So in my example here on February 10th, the issuer calculated the total of all these transactions from this one credit card account and issued me a bill of $282.08, which is called the statement balance. So a statement balance is a balance which reflects what I owe to my credit card issuer as of the close of my billing cycle, which is started on January 14th and closed on February 10th. Any transactions made on the following day or later after the statement's closing date, that means from February 11th or later, will go to the next billing cycle. Now the statement balance that gets posted on the statement closing date might be slightly different from what's called your current balance. And that's because your current balance is actually whatever your balance is at any live moment at the time, whereas your statement balance is a history of your activity during a period of time that was your billing cycle. Please note that sometimes a statement balance is worded as the new balance, which is the case here in this example. So in this example, my statement balance is $282.08 because that's my net total of all the transactions during this billing cycle period from January 14th through February 10th. Now, if on February 11th, so a day after the billing cycle ended, I bought something like maybe a cheap earbud with $20, then my current balance would go up by $20 to $302.08 because that's what my live number is for the amount that I owe. But that doesn't change my statement balance from the credit card bill because I'm in a new billing cycle when I bought that earbud on February 11th. So that $20 purchase will go towards my next billing cycle, which is going to start from February 11th and close on March 13th. So hopefully this explains the difference between the statement balance and the current balance. So back to the $282.08 statement balance which we are looking at, which basically took my previous statement balance of $353.12 plus any purchase I made on this card, which ended up being $285.39, and then subtracted any payments or credits that I had back to my account, which are $326.48 and $29.95. Now, just to fully explain these numbers, that $353.12 was my statement balance from the previous billing cycle, which ended on January 13th, which was the day before this billing cycle that you see on the screen started. And the $285.39 in purchase on this credit card bill can be found from the following things. So as you see here, on January 23rd, I paid for website subscription, which is $2.11. On February 2nd, I made another payment, which is $59. And from February 3rd to 5th, I used Uber, which cost me $224.28. So if you add all of them up, this comes to a total of $285.39. And the automatic payment of $326.48 was made on February 7th during this billing cycle, and two transactions of $13.31 each was refunded, which came from my merchant. So if you sum all of them up, this comes to a total payment of $353.12, which is exactly my full statement balance from the previous billing cycle that is listed at the top of here. Then later on, before the next payment due date, which is March 7th on the screen, I'm going to pay my full $282.08 statement balance from this current billing cycle so that I can avoid paying interest entirely while still collecting cashback or points for my purchases. Now let's try to understand what the payment due date is. So payment due date is a date by which the user must settle either the entire outstanding dues or the minimum payment. So it is usually due 21 to 25 days after the statement closing date. So this time period is also called the grace period, which is the time between the conclusion of your credit card's billing cycle and the payment due date, during which you can pay off the balance without incurring interest or late fees. So in case the payment is not made by this date, late charges will be levied. And if you do not pay the entire statement balance amount in full by this date, you can lose your grace period too, so be careful. So that means you could be charged interest on the portion of the balance you did not pay, as well as on future purchases. This payment due date most of the time is going to fall on the same day of every month. So even though your statement opening and statement closing dates might vary a bit from month to month, your payment due date will be on the exact same day of each month. Now here in this example, you can see that my payment due date is on March 7th, which is actually in the following month after my statement closing date of February 10th. So if I took at any future credit card statements, I know that I'm going to have another payments due date of April 7th, May 7th, and so on. So please note that all my transactions I made on this credit card during my billing cycle from January 14th to February 10th, where final statement balance came to $82.08, does not have to be paid back until the grace period ends, which is the payment due date of March 7th. So if I pay that full statement balance of $282.08 by the due date, which is March 7th, then I'll not have to pay any interest. Which means the rule for paying your credit card bill is basically to pay your full statement balance sometimes during the grace period, which is after the statement closing date but before the payment due date. Another important thing in credit card statement is to always make sure you read the terms and conditions that is in the credit card statement. And also read some reviews online of certain credit cards, especially ones that target customers with lower credit score, because there are some out there that might start accruing interest immediately. And you should really look to avoid those. So again, always do your own research and be careful about those bad credit cards that are in the market. Now, a big mistake that I see some people make sometimes, which really confuses them, is that they log into your account and that they see that they have a payment due date that actually falls before the statement closing date, which goes against everything I just said here. But let me address that here very quickly, because there is an easy way to solve this. So in my example here, we already saw that my statement opening date was January 14th and my statement closing date was on February 10th, and my payment due date was March 7th. I can clearly see all the dates lining up in the correct order on my actual credit card statement here that we downloaded. But where people sometimes get confused is that they might log into their credit card account, go to the home page and see something different. So in this example, they might see a statement started of January 14th, a statement closing date of February 10th, but then a payment due date of February 7th, which falls 3 days before the statement closes. And that is very confusing because it seems like there's no grace period like we just talked about. So let me explain here where the issue is happening. The February 7th payment due date that you are seeing is actually related to a previous billing cycle, and if I download my credit card statement from one period before, we could see that my opening date for the cycle was December 14th of previous year, and my closing date was January 13th of this year, and then my payment due date is the same date of February 7th. So the easy solution here is just to download your credit card statement in PDF format from your account so you don't accidentally mix up and overlap separate dates from two different billing cycles. So please always download this statement in PDF format and then check your actual credit card bill to confirm that there are no errors or fraudulent charges or any confusion. Hopefully this clears things up. Now let's talk about another key term when it comes to the payment due date, and that is the minimum payment. It refers to the minimum amount that user must pay by the due date. Please note that interest will be charged on the remaining uncleared balance. Now back to my recent credit card statement with the closing date of February 10th, you can also see minimum payment due of $25 right next to new balance of $282.08. So to a beginner looking at the statement, they might assume that that's all they need to pay now. But technically they would be correct. So in order for a credit card payments to be considered on time, which is what's important for a credit score, you really only need to make that minimum payment of $25 by the payment due date of March 7th, so the credit card company can report that as an on-time payment. But by paying only the minimum payment, you're not doing it the right way, because the remaining $257.08 between that statement balance and the minimum payment amount is going to be carried over to the next statement cycle and start accruing interest charges. That's why I always recommend people to treat credit cards like a debit card and only use credit to pay for things if you already have money set aside or coming, so you know that you can pay off your entire balance by the payment due date. If you don't have at least some cash savings and you are using a credit card, then there is a risk that some random expense would pop up at some point and you might not be able to make that minimum payment, which would trap you into the high interest credit card debt, which could be really tough to get out of. So we want to avoid that at all costs by at least having a few months of cash saved up, or by guaranteeing that some amount of money is coming to the bank account by the payment due date. Now, if for some reasons you end up missing a credit card payment by the payment due date, or you did not pay off your full statement balance, or at least you did not make the minimum payment, you're gonna be considered late, which is a very bad thing for a credit score, since on-time payment history is the top factor that accounts for almost 35% of your score. You'll also get hit with a late fee of around $30 to $40, like you can see here with this earning on my credit card statement. But in worst case scenario, if you do miss a payment, here's what you need to do. First, pay the statement balance in full if you can, because that's what you want to get in the habit of doing. But at the very least, make the minimum payment so your account will no longer be considered late. The good thing is that if you discover that you missed a payment before it passed 30 days after the payment due date, it will probably not be reported to the credit bureau just yet, so you should not see a negative impact to your credit score. But make sure you make the payment as soon as possible to avoid a drop in that score. If it's 30 days late or longer, then you could see your score drop by as much as 100 points or more depending on your situation, and the longer it's unpaid, the worse it gets. So 60 days late is worse than 30 days late, and 90 days late is worse than 60 days, plus you're probably missing additional payments as each month goes by. Eventually, if you're late too long, then that debt is just going to be sold off to a debt collection agency, and it gets harder and harder for your score to recover from. So please make sure to have enough money in that account and never miss a credit card payment by setting up the automatic payment. It's just that easy. Now, a quick bonus tip here. If you're in the 30-day period after your payment due date and you realize you forgot a payment and the late fee is posted already, please pay it off as soon as possible and call up your issuer and explain that this is a one-time mistake and you would like that late fee to be waived. If you're nice about it and if you have been a loyal customer and you have a good credit history, then you could probably get that fee removed. But again, don't be late. Don't be late. So I recommend setting up auto payment so that you don't have to worry about making payment manually, as long as you have money in the account. If you cannot do that for any reason, please set up calendar reminders a couple of days ahead of the payment due date in your phone so that it reminds you to make those payments. It has been very helpful for me. Now let's try to understand some additional terms here which are commonly found in the credit card bill statement so that you can clearly understand your credit card bill statement. They are APR, including 0% APR, credit limit, available credit, cash advance credit limit, and credit utilization. So APR stands for annual percentage rate, and it measures the annualized cost of borrowing a credit. It is generally determined as a yearly rate and can be affected by factors like the amount of credit in use and the timing of payments made by the credit holder, that means by you. The average APR was 22.3% as of November 2025 according to data from the Federal Reserve. Depending on your credit scores, the interest rate of APR on your credit card may be higher or lower. At the bottom of this statement, you can always find the APR. So in this example here, you can see that it's 28.99%, which is really high. The actual calculation of how interest is charged for any unpaid statement balance can be found online, but the point I want to make here for you is that if you pay off the full balance every month by the payment due date, then the APR is basically irrelevant because no interest or any kind of fee will be charged to your account for you to pay. Sometimes you may see 0% APR offers in the market for a certain period of time, which means that you will not be charged interest on purchases and or balances for a limited time. It may last anywhere between 6 to 24 months. After that date, interest will likely accrue on any new and unpaid credit card balances. Even though you don't have to pay interest during an end to 0% APR period, you still have to pay at least the monthly minimum payment. If you miss the required monthly minimum payment, you may lose your introductory APR rate and incur late fees. So make sure you understand this information before applying for such offers. Now let's talk about credit limit. A credit limit is the maximum amount of credit an issuer authorizes you as a borrower to use on a credit card or line of credit. Factors like income and payment history can help issuers determine credit limits. Usually you can find the credit limit on the first page of your statement. In this example, you can see that my credit limit is $5,000, which means I cannot spend more than $5,000 before paying down my credit card balance. Since I already spent $282.08 here, now I can only spend $4,717.92 as of that date, which is called available credit. You may also find a term called cash advance credit limit in the statement, which is the maximum amount you can withdraw as a cash advance. The amount of money you transfer or withdraw as a cash advance will appear on your credit card statement and interest will begin accruing immediately. Cash advances typically come with a higher APR than regular purchases, and you may also incur a cash advance fee, so you have to be careful. In my example here, you see it is $3,000, which means my credit issuer lets me borrow up to $3,000 in cash from my credit card's credit line. Now let's talk about credit utilization. The credit utilization refers to the ratio of credit you are currently using compared to the total amount of credit available to you. Keeping your credit use low, ideally below 30% of your total credit limit, may be good for your credit score. It is calculated by dividing the total balance by the total credit limit and then multiplying by 100 to get a percentage. In this statement that you see here, my credit utilization is 5.6% because my statement balance is $282.08 and my credit limit is $5,000. So if you divide $282.05 by $5,000 and then multiply by 100, you will get 5.6%, which is my credit utilization here. Now let's debunk some myths about credit card. Myth number 1, carrying a balance and paying interest on it improves your credit score. This is completely false. It actually can hurt your credit score in the long run because it demonstrates that you are irresponsible in managing your credit. Myth number 2, closing unused credit card accounts will improve your credit score. This is also false. The truth is that closing credit card accounts, especially older ones with a good payment history and high credit limits, can actually negatively impact your credit score because it reduces your overall available credit, potentially increasing your credit utilization ratio on your remaining cards. It's generally better to keep unused accounts open as long as there are no annual fees. Myth number 3, you only have to make the minimum payment on your credit card. This is also false. As we explained before, making the minimum payment will prevent late fees and a negative mark on your credit report, but it will accrue interest over the time. So the most effective way to use a credit card is to pay off the full balance each month by the payment due date, or try to pay as much as possible by the payment due date above the minimum payment. I hope this video is helpful. Please let me know if you have any questions or concerns, and really thank you for your time. I'll see you in my next video. Bye bye.